What to watch for Tesla Q2 earnings? One major new development: the clock's ticking on key U.S. EV tax credits. Thanks to changes under the BBB framework, several Tesla models, especially those with batteries from certain overseas suppliers, are expected to lose eligibility for the $7,500 federal tax credit starting September 30th, 2025. That would most likely lead to a rush of orders in Q3 as buyers try to lock in delivery before the deadline. But here's the flip side. Q4 demand could fall off a cliff, especially if customers pulled forward purchases to beat the tax change. Analysts expect this to juice Q3 sales temporarily, but put pressure on Q4 deliveries and margins. It's a classic buy now or lose the rebate situation that could distort Tesla's sales curve through year-end, and it has happened before a few years ago. Tesla has been through this rodeo before. Back in 2018, it was the first automaker to hit the U.S. government's 200,000 vehicle cap for federal EV tax credits. That milestone triggered a phase-out schedule. The $7,500 credit was sliced in half for deliveries starting in January 2019, then again 6 months later, and fully expired for Tesla by January 2020. Tesla responded with a series of end-of-quarter delivery pushes, offered priority delivery slots, adjusted vehicle pricing to soften the blow for buyers losing the tax break, and saw Elon Musk on social media urging customers to act fast. Tesla stores turned into coordination hubs for last-minute handoffs as the deadlines loomed. That playbook is a likely preview of how Tesla will respond to the next major policy shift. Under legislation passed by Congress in 2022, federal EV tax credits, worth up to $7,500 for new EVs, will expire for all automakers after September 30th, 2025, not just for certain Tesla models, but for every electric vehicle brand. With that hard deadline, Tesla is expected to once again rely on aggressive Q3 promotions, price flexibility, and a full-court press to move as much inventory as possible ahead of the cutoff. Analysts already predict a surge in Q3 deliveries as buyers rush to beat the deadline, followed by the risk of a sharp drop-off in Q4 as post-incentive demand softens. If history is any guide, Tesla will pull every lever it can to front-load sales just as it did in 2018-2019. Net effect is Q3 could look artificially strong, juiced by a tax credit-driven buying frenzy. But that may come at the expense of Q4, where reduced demand and margin pressure could resurface, especially if interest rates remain high and buyers grow more price-sensitive in a post-subsidy market. Investors and analysts will be watching closely for a repeat performance of Tesla's last tax credit sunset and to see if the company leans on the same last-minute tactics to weather another pivotal federal incentive deadline. Going back to Tesla's Q1 earnings and expectations can clearly see the picture of a company in transition. Total revenue dropped 9% year-over-year to $19.3 billion. That's mainly because of a production switch-up for the Model Y, which led to fewer deliveries and lower average prices. But there's a silver lining. Tesla's energy storage and service divisions bucked the trend, growing 67% and 15% respectively. These areas helped soften the hit from slower car sales. The market held steady in after-hours trading when Q1 earnings were released, showing investors are focused more on what Elon Musk says about the future than the raw numbers, and it might be still the case this time, or even more. Profits in Q1 took a hit. Operating income dropped a massive 66% to $400 million, and margins slid from 5.5% to just 2.1%. That's because of lower prices, fewer cars sold, and a ramp-up in spending on AI and R&D. Even though energy and service gross margins improved, they weren't enough to cancel out the drop in automotive margins and rising costs. Adjusted EBITDA came in at $2.8 billion, down 17%. Tesla's core operations are clearly under pressure. Even with weaker profits, Tesla still brought in $2.16 billion in operating cash flow and had $660 million in free cash flow. That's a big step down from last quarter, but considering how soft the profit numbers were, it's a decent result. Cash and investments rose to $37 billion, giving Tesla a solid buffer to weather whatever economic storms might come. Deliveries were down 13% to 337,000 vehicles, mostly because of the Model 3 and Y. The new Model Y production lines caused temporary shutdowns, and demand was a little soft. But Tesla says the speed of ramping up the new Model Y was the fastest ever. For example, the Shanghai factory upgraded its entire line in just 6 weeks. Super impressive. A highlight in the first quarter is that Tesla rolled out its 400,000th vehicle and launched the long-range Cybertruck. The Nevada battery plant hit a new record too. Tesla was also setting up mass production lines for the Tesla Semi and Cybercab, aiming at self-driving and commercial markets in 2026. Over in China, the new Model Y set a single-day order record, and FSD Supervised launched for the first time there. Europe focused on scaling Berlin and bringing Cybertruck to Saudi Arabia. In Q1, Tesla's Powerwall hit a record 4 straight quarters of growth, passing 1 gigawatt hour in a single quarter. While Megafactory Shanghai hadn't even started contributing to these stats yet, it's cranking out hundreds of megapacks with plans to double capacity to 40 gigawatt hours annually. Services and repairs became profitable, pushing service gross margin up 25%. The supercharger network keeps growing, up 17%, handling 1.4 terawatts of energy. In Q1, Tesla acknowledged global trade tensions and inflation are impacting cost structure and demand, so they're tightening up CapEx plans and building new models on existing platforms to stay lean. That might mean less cost savings from new factories, but better capital efficiency. The goal? Maximize output, especially for robotaxi, which was targeting mass production in 2026, using Tesla's signature unbox manufacturing style. Tesla is turning its charging stations into places you actually want to hang out, like the Tesla Diner. Since fast charging still takes 20-plus minutes, this could become a big differentiator and another revenue stream down the road. The Tesla Semi wasn't in mass production in Q1, so it's not driving revenue, but it matters as a testbed for high-powered batteries and energy modules. As U.S. transport faces carbon taxes and stricter emissions rules, Tesla Semi could unlock a whole new B2B growth path that complements its consumer car business. Powerwall 3 was producing 1,500 units per shift, a big step up. With great instability and growing AI infrastructure power needs, home storage was becoming less of a backup and more of a basic need. Tesla was riding this wave by scaling production, grabbing more market share in home energy. The first Megapack rolled out of Tesla's Megafactory in Shanghai, marking the start of a local energy supply chain in China. While it's not in Q1 deployment stats yet, on-site photos show the plant is ready for volume. Backed by local suppliers, this factory helps Tesla cut export dependence and strengthen its position in Asia's energy market. Tesla's Optimus robot has entered pilot production in Fremont in Q1. The long-term goal is to lower factory labor costs and eventually enter other industries like manufacturing and retail. It would be interesting to see any updates on this end. If Tesla can get Optimus working internally by 2025, it could launch a whole new revenue stream outside of vehicles and boost Tesla's image as a real AI-first company. Tesla's net income fell hard, from $2.13 billion in Q4 2024 to just $410 billion in Q1 2025, down 71% year over year. Part of that's seasonal, Q1s are usually weaker, but most of it is from the Model Y production shift, R&D costs, and rising competition in China. Free cash flow dropped from $2.16 billion to $660 million. Despite the profit drop, operating cash flow was stable at $2.16 billion. That means Tesla still runs a tight ship. Lower parts costs and better inventory turnover helped that. Adjusted EBITDA slid to $2.81 billion, still healthy, but the growth momentum's clearly slowed. 12-month free cash flow bounced back from $1.38 billion in early 2024 to $6.78 billion now. That's better, but still below the $8.9 billion peak back in 2022. So yes, Tesla is fixing its cash flow, but it's still in recovery mode. Trailing 12-month net income fell again from $14.99 billion in Q4 2023 to $6.11 billion now. The message is Tesla still relies too heavily on a few products. Without new profit drivers, EPS could stay under pressure. Adjusted TTM EBITDA was $15.49 billion in Q1, down 20% from the $19.39 billion high in late 2022. It's still a drop, but less steep than net income. That showed Tesla's underlying cash-making engine still has some strength. Tesla's profit volatility was growing in Q1. With major product transitions happening, how well it allocates resources and manages production shifts will determine its ability to withstand pressure. Tesla's free cash flow is bouncing back without compromising financial discipline. That's a big deal for investor confidence and credit ratings. But to get back to the 2022-2023 hypergrowth vibe, Tesla needs to make Cybertruck, Robotaxi, FSD, and Optimus real profit engines. Automotive sales fell hard to $12.93 billion, down 31% from last quarter and 22% year over year. The Model Y transition disrupted deliveries, and average selling prices were crushed by discounts and FX issues, especially in China and Europe. Leasing revenue stayed flat at $450 million, in line with Tesla's push to speed up deliveries via leasing. Energy revenue hits $2.73 billion in the first quarter, up 67% year over year. While slightly lower than last quarter's $3.06 billion, it's still strong. Service revenue stayed flat at $2.64 billion, but margin improvements show that it's finally turning profitable. Total gross profit was $3.15 billion, down 15% year over year. Gross margin dropped from 17.4% to 16.3%. Even though Tesla cut costs, those fixed costs like depreciation and labor are sticky, and they're hurting margins as volume drops. Operating expenses rose 9% to $2.75 billion. R&D jumped 22% to $1.41 billion, signaling Tesla is still investing big in AI, self-driving, and Optimus. S&GA dropped slightly to $1.25 billion, showing cost discipline despite slower sales, showing long-term innovation is still a top priority, but short-term profitability is taking the hit. Operating profit fell to $409 million, lowest in 2 years with a 2.1% margin. Interest income was strong at $400 million, but other losses dragged pre-tax profit down to $589 million, down 69% year-over-year. Net income to shareholders was $409 million, or 0.12 GAAP EPS, pretty much in line with conservative market expectations. Tesla's total assets hit $125.1 billion, up 2.5%. Inventory rose to